Hey, good morning, everybody. Welcome to our Candid Coffee, latest edition of Financial Independence. We appreciate you guys spending your Saturday mornings with us. Today, we're going to do a little bit different. Typically, we try to keep these kind of off the cuff, take questions, which we still will be doing. But a little housekeeping. If you have any questions, go to the Q&A or the chat room. You can ask questions right there. We will try to get to those today before our hour is up. We are going to go through some slides today. This is going to be a really great kind of taking it back to the basics presentation, really talking about and discussing what is important to lay the foundation. And we're going to go through some things that may spark, things that you've heard that you probably already know. We're going to bust some financial myths in the sense of, a lot of the industry guardrails aren't really there for you, but for the industry to make money. And so we're going to talk a little bit about those as well. If you have any questions on that as we go through, please don't hesitate to ask. And, we're going to jump right in here, Rich. So,
well, and keep this in mind. This is not just the foundation. This is the foundation under the foundation. This is the big stuff, right? This is so simple. We don't follow them. And I was talking to Lance yesterday, and I said, I talk about it on the radio show, looking for a new house, but I don't break my own rules in this program. I'm not going to say, Danny and I, that these rules are easy. They're not impossible. No. They take discipline. I would dare to say that many of you on this today follow these rules. I am hoping you would pass these slides, this presentation, once recorded, on to people you love. And that's what I'm hoping. Danny and I are really hoping that you share this with your other generations who are going to roll their eyes because it's going to oppose and conflict what they hear from mainstream financial media. Danny and I, we have one agenda. We want to make sure you get what has worked for families who grew wealth and have financial security. And some of these you'll like, some of them you won't. I would be interested, Danny, for the radio show to hear from everybody on here today when you email us. Which rule have you followed that resonates with you? Which rule out of all of these you take to heart and use, and how? Couple of sentences. I think that would make a great show for the masses. Don't you, Danny?
I agree. And so a lot of these things are stuff that, one thing that we do is, and we take to heart, is that we practice what we preach. And so we think that's extremely important. What good are we to you guys if we're not doing the same things? And, we also learn a lot from y'all as well. And, that's helped, right, shape and mold some of the things that we do, because we've seen past experiences that have maybe failed, a lot that have been successful. And, you get to gain some of the knowledge and experience because of that as well. And so that's why we wanted to just take it back, talk about financial independence, and really break it down for you guys today. So we are RIA advisors, or Clarity Financial doing business as RIA advisors. You also see realinvestmentadvice.com. I'm sure, many of you guys hear from us in different ways. We have lots of different ways to communicate, but let's talk a little bit about, what does financial independence mean to you, Rich?
I learned it subconsciously by my money script. The patterns I've analyzed around debt and investment that come from a place from when I was a youngster and observed my grandparents and my parents' relationship with money, right? So you got to be honest and really analyze where your money script comes from. My parents were profligate spenders. My grandparents, being Depression era, were incredible savers. And here I was stuck in the middle. And I knew how I wanted to gravitate more toward where my grandparents were, because I saw the distress on my parents. So this is a peace of mind that goes along with also having enough income to pay expenses, possibly for a lifetime, but just to know you're covered. And you've got to understand, many mainstream financial rules are very suspect. I don't think they're corrupt. I don't think they're trying to mislead you. I think their goal is to sell product, keep you engaged, keep you indebted, and live up to these unrealistic standards. And who are you really serving? You're serving others, not yourself. So keep that in mind.
So, like I mentioned, we are Clarity Financial, doing business as RIA Advisors. We are registered investment advisor with the Securities and Exchange Commission. We think this is really important. One, we're not selling any product when we talk about any of these things. And in fact, we get questions often on, where's the product? What are we doing at the end of this? Where's the annuity or whatever it may be, the fund?
Mm-hmm.
And we're not designed that way. It's strictly our expertise. So as a fiduciary, our goal is our product is that expertise. And so we hope that you guys gain something from this, and that we're doing this in many different ways. And of course, if you are a client, we hope that you gain some valuable information. If you're not, and you kicking tires, looking around, we'd love to see if we can't find a way to help you. So hopefully everybody gains something from this. And like Rich said, it's something you can pass along to others. So today's agenda, we're going to talk about really general, just, like I said, bringing it back to the basics, general debt savings rules. What are steps to financial independence? And then what do you do when life gets in the way? And I can tell you, it's interesting, and we're going to talk more in depth and detail about this, but life gets in the way frequently. And, we saw it with the pandemic. We see it with a number of things. Shoot, I just had an injury that I can tell you it has gotten in the way. And, it's one of those things that, sometimes you just can't control. And so being able to, fortify your household and your balance sheet is going to be extremely important to make sure when these bumps in the roads occur, you guys are going to be protected. So Rich, let's jump right in.
Well, we created guardrails, and we're going to go, these are available on the website. I'm not going to spend a lot of time on these because they're available, and we talk about them all the time, but these guardrails are there to prevent you from veering off course, right? Drift off target, travel a path that places you in jeopardy. It happens, right? So a couple of things you have to keep in mind, and one really relevant, the annuities should be planned. In other words, when people have annuities, Danny and I look at people that have annuities and they sort of collect them and they don't know what they do. They go to an insurance salesman, they're sold in I don't even know if you need until you have a plan. I want you to understand the ultimate purpose of an annuity is guaranteed income for life. That is why we're so proficient at Social Security and helping people make the right Social Security decisions, because that is income for life. And also, overall, holistically, look at your assets and make sure you're not going to outlive them. Longevity risk is a big thing. Keep in mind, if you're out there looking to buy an annuity and you just called your insurance broker, and I just drove by an insurance agency and says, hey, come in and ask me about guaranteed income. Guaranteed, when you sit with that individual, they don't know the rest of your story. They don't know you holistically. They're just going to say, well, here's the annuity, bells and whistles. This is how much you're going to put in it. How the heck would you know how much to put into an annuity without a plan? This is where they get a bad rap. All right. So you've got to be careful, because guarantee, and the reason I added this as a guardrail is over the next 10 to 15 years, with the way valuations are on markets, and I mean a massive headwind to returns, lower returns for risk assets like stocks and bonds, even though right now it looks like party time, right? Eventually, as Lance says, math comes into play, reversion to the mean in some form. If I had a guaranteed income stream coming in on one side and I didn't have to really ask too much of my risk assets through that period, then they are beneficial. But people come, I don't know about you, Danny, people come to me all the time. They go, hey, I think I heard about annuities. And actually people getting more receptive to them, right? My advisor says I need to put 200,000 into an annuity. And I'm like, well, how much do you think I need to have? I said, I have no idea.
Yeah.
I have, unless I do a plan for you, he doesn't know, or she doesn't know, and I don't know. That's what a fiduciary is going to help you do. Also, very relevant today, your primary residence is a place to reside, not an investment. And that looks really stupid, Danny, over the last year and a half, right? When you see the Case-Shiller index and houses growing 15% year over year, in some cases
23%.
23%, right?
Was the average. Yeah.
I will tell you, this doesn't last, right? So you have to have a level head when you're looking for a home. Right now, I track houses throughout the country, and tracking waiting periods. I talk to realtors who have been not in the business for like 6 months because they need something to do, but have been in the business for well over 20 years, who are telling me the market's starting to turn, the market's starting to move. And it's not yet a buyer's market, but there is becoming a more leverage as houses get priced out of people's pocketbooks. So I need you to understand what a primary residence is. You're going to live in it. Yes, we hope they grow by an average about 2% a year, whatever the rate of inflation. So hopefully you don't lose money. Although I will say, Danny, I think people today, if I'm going to go buy a home and I'm going to spend 50 to 75,000 more than it's worth, generally, it's just because of the demand, right? If I only put 5% down, I have to mentally deal with over the next few years that I might be negative. I might lose my down payment, and people understand if they lose money in stocks somewhat. They don't understand when they lose money in a primary residence. Doesn't make sense to them because they've been told your residence is an investment. Well, what do investments do? If you want to think of it that way, they don't only go up, they go down. So if you're not going to put 20, 25%, maybe even 30% down to buffer any downside or flat pricing over the next few years, you're going to be in for a big shock. So you have to calculate what your primary residence is. I want you to walk into any new home you buy and take the emotion out. And I know it's tough, man, because I fall in love with houses all the time. But I step back, I have a notebook, I look through, and if something doesn't look right or feels right to me, I stop. And I'm not saying it's easy, but if you go in with this mindset, you will make better real estate decisions.
So this is a big one here. So never allow others to cross your personal financial boundaries. I mean, this is something that is difficult to do because you're going to have people who are always tugging at you for different things. And a lot of times it's family, it's children, it's friends. But you need to set some boundaries to understand, what you're comfortable with and what your household can really, afford to do. Because many times, we talk about, Rich, you and I visit with lots of different people in the sense that they say, okay, well, hey, I'm going to give a loan to XYZ. What do you think about it? And, one of the first things I always mention is you better be real comfortable not getting paid back on that. And you better understand what that's going to do and the impact to the dynamics of the relationship or the family or whatever it may be, because there are many times that, the kids don't pay you back like you thought they would, or they don't pay you as much as they said they would, or they just don't pay you at all. I've seen all of those things occur. And unfortunately, that's probably more frequent than not. And sometimes some of the best things you can do is actually say no. I've heard from people and friends that I've helped and probably maybe, gave them, helped them too much. And it allowed them to not do the things that they probably should have done. And some of the best things that, I've heard back is like, hey, like I had a college roommate who fell on hard times when we graduated from college. I let him live with me, had to boot him. And he's like, man, that was the best thing that ever happened to me. And he got on his tail and he's extremely successful and he does very well. But I think that's really one of the things that everybody needs to understand within your own household. What is it that you're doing? What's the overall goal? And will you actually be paid back? I'm great with helping people. I think it's extremely important, but you need to understand the dynamics associated with it. And then create your own financial rules around the debt and then savings and make sure, that you stick to them. Many people come up with these great ideas and they jot them down on paper, but then they never execute. They put them in a drawer, just like a lot of financial plans we see, Rich. Making sure that we're actually sticking to these rules, utilizing them. And then, if you can even go above and beyond, and that may not be every time or every month as you're saving, you're going to be far ahead of your peers in the future. That's one question I seem like I've been getting a lot, Rich, lately is, how do I compare to everybody else my age? Have you heard that a lot recently?
Yes. I think it's a great comment because studies show your children, say mid-30s, their net worth compared to where your net worth is in the mid-30s is nowhere near. You always expect more from the next generation, and it's turning. So people do not only want to compare to others, they want to compare to you as well. And when you compare to, I think this is a slippery slope because I get the question a lot. And what I try to help people understand is, listen, these are your goals, your rules. So your neighbor who you might perceive as doing better has a different set of rules, different set of risk taking, possibly more leverage. So you got to quiet it down. What is good though is when you run a financial plan, it showcases all the good things that you're doing. And it's good to focus on those. And this brings up another point. Take the word financial out of personal financial boundaries. Boundaries are more than financial. They're mental, they're physical. There are so many boundaries that you have that if you just create boundaries, and my friend James Altucher is a best-selling author. He wrote the book, The Power of No. I'm so good with no. No, for me. Don't feel bad about it at all anymore. You exercise that. You then apply that personal boundary, whatever it is, to the financial side of your life. And I will tell you, you'll follow your own rules, your own tenets. You will follow your own beat that has nothing to do with what anybody else thinks or how you think of others. And I'm not saying, again, it's easy, but once you do it, it feels amazing. You are empowered. Don't you think, Danny?
Absolutely. I mean, I think it gives you that empower. And, financial security in general and that financial independence is really about empowering yourself for your future, protecting what you have now, but also setting you up for positive results. One of the things that, I always express is that, look, when we're trying to compare, and it's an easy thing, right? One, sometimes it's like keeping up with the Joneses. And this is a good aspect where I want people to say, hey, okay, I'm doing pretty good. Or maybe I need to step it up a notch in this regard from a savings perspective. But let's face it, we typically deal with the more affluent rich, and in general, they're probably much better off. I think that most people, when they see what the numbers are, what the average and then what the median is for people at different ages of savings, they're shocked, and they don't understand how people can live this way. And, the other aspect is, what's that magic number that you need? You see all these commercials, talk about the financial media and things they push, and everybody has this huge astronomical number. But then when you break it down, when you see that number, it's difficult because you say, oh man, I'll never get there. But when you start breaking it down, it's a little bit different perspective on it. And, we tell people who have very little, they can retire. We tell people who have a lot, they can't. And it's going to be based on so many variable factors, their age, their spending, what all their debt looks like, their goals. So much more goes into it. So there's no magic number out there. Don't be taken by that.
Yesterday, I was driving into the office yesterday, and
what's that like?
Sort of dangerous.
Yeah.
This Corvette cut me off. Beautiful Corvette. And I was like, boy, that would be nice to have, this Corvette. Then I'm realizing you're driving this crappy road along with me. And if your front end goes, you're going to be more upset than I'm going to be. In other words, I don't compare myself anymore. It comes to me very quickly, and I'm able to allay it and realize that, oh man, I wonder what that must have cost. Where could the money have gone in my life versus a new Corvette, right? Am I having some middle life crisis that I need to drive this Corvette down Louetta in spring, right? That looks like the moon, or I'm going to drive something more reasonable. So I will tell everybody, you've probably read the book. If not, please think about it as a holiday gift. The Millionaire Next Door. Amazing. One of the best books I still have ever read about the unassuming way people and their decision-making. It was a book. It still holds up after all these years. What a great, I already purchased it for Haley for Christmas. What a great book to share with others and maybe reread for yourself.
Yeah, I agree. And you know what though, but Rich, one thing I want to make a point of is that it's okay to go out and reward yourself. And if you feel
Of
like you
course.
want to go buy that shiny Corvette, great. I'm all for it. But make sure that all the rest of your financial household's in line. I don't have any problem with that, or driving nice cars or nice homes. I mean, make
course.
sure that everything fits together, and that
Fits together, right? You
Yeah.
got to put it in your plan, right, Danny? Like we have people that
Correct.
put, I have a client, he's the best. I love him. I got to have this Porsche. I worked all these years for this Porsche, but guess what? All his other financial stuff was in great order. I said, I want to take a ride in your Porsche. In other words, we planned it. It doesn't interrupt his overall situation, and it fits. It just wasn't some emotion, even though I could hear the emotion in his voice, how badly, and his wonderful wife rolling her eyes like, how am I going to get in and out of this thing? But most important is you're not here as an advisor to shoot anybody's dreams down or cut them off at the knees. Sorry, Danny. You are here as a plan to say, give us the sky. Let us know what you want to do. If it's possible, yes, you have to enjoy your money and buy what you want. Just make sure it fits. And if it's a Porsche
my
or a new
goal-
yacht or whatever it is. I had someone that wanted to put a chicken coop in, right? This was this big dream, right? We went through the plan. The chicken coop sort of didn't work. Price of lumber. Now we figured it out. And he said, we made it work. I think everybody's dream is different. We're not going to discount what your dream is. It's just whether it's attainable with all the other goals and other risks, financial risks that can come along. If we consider the fact, again, life gets in the way. What are you going to do?
Hey, and I'm all for that. I encourage clients to put down, their far-fetched pipe dreams and say, hey, let's see if we can't get you there. How can we get a path to attain these? And so if that's one of your goals, let's try to figure that out and get you to where you need to be and want to be. So I'm all for that. I think it's a great thing to do. Don't feel bad because you want to do those things. That's okay. I think that, this world we're living in right now, everybody wants the nice things, but then once you attain them, everybody goes after you for it. So I want to make sure that we make a good point of that. So Rich, we talk about guardrails, and this is one that I know that we both live by. What do you think about this? I mean, so mortgage debt, this is huge, especially in an environment where, typically, administrations in the Oval Office are pushing for different things. And that's been happening over the last several decades where everybody needs to be a homeowner. You see, when we get in tough times, these stipulations they tighten, right? And then, we're back to 3 to 5% down once again. And people get in way over their heads, too often. And
they do.
The rule
they get
of thumb,
over leveraged, even though interest rates are low. They get over.
So debt is 28% of your gross. Is what the common rule of thumb is 28% of your gross income is what you should be able to afford on mortgage debt. In general, the whole big picture is actually 35% when you take any other debt into calculations, right? I think those numbers are a bit high. It's going to make it very difficult for you to save if you get in hard times. If you blow out your knee and you can't work, I mean, whatever it could be, right? I mean, number of things. But having this 2 times gross salary, I think it's probably difficult, Rich. I mean, shoot, the average home price now is $363,000. I don't know how you do it. I mean,
I'm sorry. What can you do?
You may have.
I saw this
rule here.
I saw this crazy video on TikTok from a realtor. It was criminal. Actually, I think it was criminal. But she was saying if you make $55,000 a year, you can afford up to like a $400,000 mortgage. And I'm like, I know I make more than $55,000 a year, and I don't want a $400,000 mortgage, right? If I make 50, I can do a $100,000 mortgage. Maybe it's a condo. Maybe it's a very small place. Maybe I wait.
You're renting a room from somebody, Rich.
I'm sorry. You know what? Especially today, right? Especially today where houses are overpriced. I think you got to look at this rule as a baseline. Maybe if you work that out, maybe you look at it also as a percentage of, right? Because right now I don't exceed a mortgage payment 10%. That's 10% of my net income. That's my rule is 7 to 10%. You know, like when you go for a blood test and you have a range, your diagnostic, I've got to follow my own rules, right? I've got to follow my own rules. More austere, right? My personal unsecured debt is no more than 8% of my monthly household income, which means I live below my means. So we'll talk about how you increase your income, right, to make this equation work. So your children might laugh at this rule, but in the back of their minds, they're going, what are they trying to tell me here? We're trying to tell you not to be house poor. If you look at statistics, a mortgage payment is now taking up close to 50% of a family's gross income. What else does that leave you room for, Danny?
Not much.
If I'm house poor. Well, my house is worth more. Well, what does that mean? What do you do? Are you going to sell it like Lance would? Like I'm going to sell my house at the top and go move the family into an apartment? Lonnie asked if these are all independent of the others. I use them together. I couple these. I follow every one of these. The second one with student loan debt, some of it's a personal preference. My daughter, I didn't want her to have student loan debt. So I worked that out with a 529. It's literally as soon as she came out of the womb and I got a social security number, I started a 529 plan. And I funded it over 16 years. Okay. But we talk to students all the time and say, listen, you could take 1 year's worth of student loan debt if you need it. You can drag it out over the 4 years, whatever it is, right? But I want you to be level-headed. There was a great article in the Wall Street Journal, I don't know if anybody read it, about degrees, especially from Columbia, where kids are paying, they're getting into like $180,000 of student loan debt, Danny, and they are now making like $40,000, $50,000 a year in a whatever they like. It's theater or social work. They're never going to be able to pay back those loans. We don't want our children in that situation. So these are not hard and fast rules. I want you to just engage them and create them for yourself, right? This is the foundation or below the foundation. Now as a family, you're going to build on, you know what? That more than 25% of monthly household income for personal unsecured debt. Even if you exceed it, you're calculating the number, right, Danny? You're more conscious, right? I'm creating a hiccup in your brain. All right, I'm in your head. I'm creating this hesitation for you to run some simple math before you make the decision. That's why I own a Toyota RAV4 hybrid, right? I could own the Corvette. I don't want to own the Corvette. What do I want to own the Corvette for? I want something that's going to keep my own stricter guardrails. So what I do is I follow my own guardrails, but I cut them in half. And I'm surprised I haven't lost all my hair yet. Danny's following the rules 100%. You let his hairline speak. Let his hairline speak for itself. So we want you to share these rules. And if any of your kids want to talk to us about these rules, like you guys are drinking something in that Candid Coffee mug, right? We don't know what's in there, but it's not coffee, right? We can help them level that foundation. I got it to where my daughter, Danny, one last thing. In my book, I wrote about how every kid should go to community college first. Like you get all your basics, and by the time you graduate, right, the community college isn't even on your degree, right? She came to me and said, Dad, I think I would like to go to community college first. I'm like, oh my gosh, this is great. So enough on that. So these are the rules. Now, you don't have enough income, right, Danny? What do I do? I want to, if I want to make $100,000, I'd like to have a $200,000 mortgage. But how do I do it? What do I do, Danny? Help me.
I think you need to invest in yourself. And this is one of the things that, we're seeing more and more people do that. I think the pandemic did make people realize that, okay, they maybe had additional free time, or, that they were at home with maybe a little bit better work-life balance. They weren't spending so much time in a vehicle or outside activities. Said, hey, let's start spending time on, bettering myself to improve life in the future. And I think this is a huge thing it's often overlooked, because this isn't easy, right? We all want to strive to do better, but you've really got to put your nose in a book, or you need to, attain a new skill. You have to spend time at this. And this is not something that'll just, it doesn't just pop up and it just works. It is, increasing that capacity to earn little by little over long periods of time. And what we see is, as you're building that human capital, this can be fantastic. And this is one of the things that is overlooked. We talk about those things that are overlooked, or we do incorrectly. This is probably one of the biggest things, because think about this: all those funds that you earn and all the things that we talk about from the financial planning perspective, those are gained because you have a skill, you have a trait, or you have something that benefits that productivity that's good, that, you're producing things. And this is one of those areas that, as you continue to improve, your chances for a raise, your chances for another position, or maybe even a career change, go up substantially. And so if you go back and look at the big picture, all of those things and all those decisions that you have to make at the end with, okay, where do I put the 401k money? Am I maxing out the HSA? Am I using all these things properly? All of that money comes from your human capital. Rich, you're muted.
Yeah, we're getting nudged that it's time for a mug giveaway.
Yep. So first mug is going to go to Richmond Vaught. So Rick Vaught, thanks for joining us today. We appreciate you guys. We'll get you a mug in the mail. You'll get with Nikki. She'll coordinate all that stuff for us. So, and thank you, Nikki, for all you do behind the scenes. So you don't see her today, but she's the one who's helping, make sure you guys understand what we're going to talk about, getting the information out, making sure everything's set up and running smoothly. Very much appreciated. So Rich, elaborate a little bit on the human capital and put it in perspective from that earnings perspective, long-term.
You aren't well, last thing I'll say, because we want to move on, you're an investment. You are the greatest investment. Your skills to grow and make more money, that's what you are. There are people that are consistently reinventing themselves, especially like you said, Danny, through the pandemic. We're seeing small businesses really start to arise. And that's because people are trying to figure out better things for them to do. It could be taking a course, right? Being better at Microsoft Office, whatever it is that you feel is going to move you ahead, either where you work now or to move on, is I am an earnings machine. I've got to increase what's coming in on this side, and then I can maximize and use the rules on this side, and it's all good. It's all good. So don't forget yourself. Not the stocks, not the bonds, not anything else, but you're the greatest investment.
All right. So this is another thing we talk about often, is health and wealth and how intertwined these things are. We talk about how much, the elephant in the room, long-term care further down the road, what a significant health issue can do to a financial plan, and what you can do to to minimize some of the risk that you face by, decisions that we make. And you always joke, Rich, what do you say? Every donut you eat costs you how much?
Every bad thing I eat, I take $100 off my retirement.
Man, people are gonna hate you and probably us
mentally
for all of these things, because you're taking all the fun out, man. What's going on?
Because I'm no fun. I am no fun. I've realized that. So the thing is, I look at by the beginning and the end of the week, what I've done healthy wise and what I've done. Again, this has nothing to do with money, right? I'm not going in my accounts and moving anything. It's mental, right? If I ate well 5 days of the week, I'm giving myself $100 a day. And if I have, and then 2 days a week, I didn't work out or whatever, I subtract it. right? The goal is to move forward and get better from a health perspective. It's just a way for me to keep it in perspective that you want to be healthy in retirement. And that's my stupid way of keeping track of myself.
But I think that's a good way to do it. I mean, I'll do that with just even expenses. If I, pandemic, I started cutting my own hair. I don't have a whole lot. I figure if I screw it up, I can just shave it. So put money aside, similar to what you're talking about with health. If you go out and you maybe splurge a little bit at dinner, maybe you work out an extra time, or you really button it up. I think that all those things are very intertwined and need to be considered, big picture, right? I mean, these are all things that are little behavior or little items or things that you do, but they all add up over a long period of time, which is really important. So looking at the numbers, right? The average 65-year-old couple, $400,000 with health use services estimates. Fidelity, similar. Lots of these studies show very similar as far as what a couple can expect to spend in retirement on health. And this is a dramatic number. One of the things we'd also encourage you to do, and we do have a couple more slides. We want to get to some questions. Is make sure when you're doing a financial plan that you're sectioning off the health aspect of things, what your health insurance premiums look like, what your out of pocket looks like, because we generally want to inflate that at a higher amount. So you can see here, Health Use Services projects at 5.5% annual increase in healthcare costs. That is something that we actually put within our own financial plans. So we want to make sure that, you're looking at that and we're inflating that at a larger amount.
This might be a good time to tell you, Danny. I think Nikki will agree. You should get your hair cut by a professional.
Whatever.
Just kidding.
Like I said,
listen,
shows why people don't like you.
He's like my little brother. How long are we working together now? 10 years. You were like,
feels a lot longer. I have no idea.
You were like 15 at the time when you.
Yeah, something like that.
Yeah. So the steps to financial independence. This is a great quote. Rich people manage their money well. Poor people mismanage their money well. I thought this was pretty cool. This is a great book, by the way. It's not one of my favorites because I think he's a bit of a hole, but the comment is pretty cool, right? And so I think that this works pretty well. I think it hits home when it comes to mind perspective, right? Because there are people who don't have any money and they have this mindset, Danny. Like we work with them and we know if we're going to be alive in 25 years, like, oh my gosh, these people are going to be like they're going to do really well. We can, we've been working with people so long financially. We have this sixth sense. Woo. We can hear what they say, their language they use to themselves. We know, again, they might not be the wealthiest people, but they will be financially independent. And it's good to see it, to hear these kinds of things. And all these kids that I've talked to when they were 16, 17, 18, and now like 30, 35, and they're doing these things. It's incredibly rewarding for me to see, because I'm like, that kid's going places. That kid's going places. I have one son who's in Austin now. When I started talking to him at 20 years old, he's 31 years old. He's already a millionaire. Amazing. Like I could see it in him at 20. Like this kid, I don't know where he's going, but he's going places.
Well, establishing those things, making the hard choices at a younger age makes it a lot easier when you get older, right? Because now you do have that financial independence. You have the ability to go out and do the things that you want. Now, maybe when everybody was in their 20s, was it more difficult for you to do so, to make those decisions? Absolutely. But you're going to reap the benefits for years to come.
Yep. We talk about this all the time, right? 9 steps. We'll go real quick. 1, pay yourself first. If all the rules out there from the financial industry, it's one of the best. I've always done it. It works. You save and then you work at the budget. So you force feed it and then your savings, and then you adjust your cash flow. You go in today, you increase your 401k contribution from 6% to 11% today. And you go, uh-oh, what did I just do? Guess what's going to happen? You're going to work it into your budget and you're going to be saving more. Know when to mitigate risk. right? You got to know which risks you can absorb and ones you must mitigate. You put your ego aside when it comes to insurance because we're going to die. We're going to be disabled. We're going to suffer a health issue. Just face it. Know how to mitigate the risk. Dodging financial bullets by mitigating risk is very important. So be more Clark Kent, not Superman, right? Clark Kent, like on kryptonite. I am a human. These things are going to happen. I'm going to die. Is my family protected? You got to just face it. And once you realize how good a thing you did for them, you will feel better about your decision. I noticed, Danny, when people start to really look at financial risks and they overcome that hurdle that they are human, they're almost excited. They're almost excited to say, gosh, if I am not here, my family is covered. Like, I feel so much better and smarter and a better dad, a better mom, a better person by doing these things. So you got to really know that risk is out there and it could happen to you.
Yep, absolutely.
Right. Again, you got to ignore these debt to income rules that are out there. Our rules are tough, but they work. I pull these rules from people who I've been working with for years, books and other things, and I've actually made them harder, right? You got to broaden out from stocks and bonds, right? Your true diversification. You talk to a broker, that's all they know. They won't talk to you about insurance. They don't understand. The only world that they have, the panacea, everything is stock market. There is more out there. You are tilling and farming an investment field. I have rows of investments, right? Passive income through real estate, overfunding permanent life insurance. It's not just stocks and bonds, everybody. We are holistic in nature. If you expand out, you know how much money you're willing to risk, you do it, right? It's not easy. It takes knowledge, it takes learning, but you can do it. And then you up your skill set, right? The human capital, the earnings machine. Danny, I am amazed how many courses are now available than ever through like great schools for like pennies on the dollar. Like I'm going to use some of the Ivy Leagues, but like Harvard and all that, like they have courses, MIT in mathematics. They have courses you can take. There's these learning universities that you can just do it on your own. I mean, it's the empowerment of the internet and having this. You should always be learning. Always be learning. That is going to increase your earnings. Learnings equal earnings. That's our new mug, Nikki. Learnings equal earnings.
Hey, speaking of mugs, we want to give another one away.
Hey,
so Mr.
mug.
Dalal, thank you for joining us today. Get with Nikki. You guys can coordinate getting that mug to you. So we appreciate all you guys. We know there's a lot you guys can do on a Saturday morning.
Yes.
Bright and early. We appreciate y'all being here. And really for the questions, the information you give us, I mean, it's very, it's a two-way street. So we appreciate everybody. So this is the one that I love, Rich. Ignore what your neighbors do. I mean, how many times have you heard of somebody getting their mail and their neighbor says, you've got to go buy this stock. I've made so much money. And then somebody wants to jump on it and it's too late. Now, here's the kicker too. Have you ever talked to somebody who's actually lost money in the market or made a bad trade?
Oh, no. Every fish is huge.
Yeah, nobody's ever lost.
I made 100%, 50%. This is the best thing since well, how much money did you lose? Oh, what? No, I don't lose money. Are you nuts? Don't be crazy, Danny. Yeah, forget what your neighbors do. If they need help, help them, maybe, if you like them. If not, don't worry about it. All I'm saying is ignore it. And this is part of the millionaire next door, right, Danny? They don't compare themselves to others. So avoid investment advice from your neighbors. No, please watch for the big returns, high yields. I'm making 15% in income this year. I mean, I'm not saying all these investments are bad. What I'm saying is you do your homework. You do your homework. You just don't take somebody's word for it, right? And then you want to diversify your accounts. You maintain, and we talk about this all the time, pre-tax, tax-free. Because if you don't think taxes are going up for everybody in the future, you are wrong. Wrong. They are. You've got to create an income stream, all just not from pre-tax money, but from post-tax money. Roth. All of a sudden now, Danny, we've been talking about Roth for 5 years, Roth IRAs. Now they're like the thing. And now I'm wondering if we should be talking about them anymore. So diversification of accounts as well as investments. I helped somebody last night, who's contributing to a new plan, and he really wanted pre-tax. You know, he's been told this. I said, why don't we do both? We do 25% of your salary deferral in pre-tax IRA, 75% Roth. So we came up with a doable allocation that he can live with as a new employee.
Yeah, I think that's important. You know, so diversifying those accounts is really a big thing. We just did receive a question that says, I'm in the process of changing my pre-tax into Roth. Why would I keep pre-tax accounts? I think it's a great idea, but you also need to be mindful. So depending on your age, there are some things that can occur if you take too much out. So from your pre-tax, or do that conversion. And this is where I think it's really important to understand. And this is why we want to take that holistic big picture view, because so often you may visit with somebody and say, yeah, do it all. It sounds great. And ideally it does, but you can also spark some different expenses or things that you just may not be aware of. And I talk to people frequently that say, wow, my Medicare premium. So if you're over 65 on Medicare, you could have Medicare, you could have surcharges on your premiums, which can negatively impact. So, you know, we're looking at a number of things. Obviously we want to, you know, our job is to protect and grow money, but it's also and not just in the market, it's to protect it from taxes and additional expenses. So there's a dance to how you do it, right?
There is. I love the enthusiasm, because if it were up to me, I have to tell you what I would do. And you guys know, I always tell you, I'm pretty open book, right? I want you to learn. We care so much about all of you. If I could do it again, I would never dollar in a pre-tax account ever again. I'm writing a piece about this for the blog in the next couple of weeks. I would never do it again. I would have Roth and I would have permanent life insurance. That's what I would do. No taxation on my Social Security income, no Medicare IRMA charge, no Medicare surtaxes, none of this other stuff. But that's me. That's me. I want the ultimate flexibility. And I do think, unless taxes are going lower, and I'm trying really hard not to laugh. I think I hurt myself. I might have to go to the emergency room after this. So I need you to understand that, to Danny's point, just keeping it in your mind and working out a formula that works for you. Hey, if you can convert it all and it works for you, and you're able to pay the taxes from an outside source, and you got years for that to grow, you got a legacy issue. You want to leave your money to your children, and they're in a high tax bracket. Well, guess what? They have to take the money now out of an inherited IRA now over 10 years if you pass away. They can do it tax-free if you want to leave the Roth as a legacy asset. So there's a way to do it. So I really like I like your enthusiasm, because that's what I would do. So life gets in the way, right? We wanted to have how to prepare for that just for a little bit.
Yeah. So life obviously gets in the way. For years, or for really, about 2 years ago, you and I started talking about other ways to mitigate some of that additional risk. Markets were expensive. This was pre-pandemic. We thought, you know what, this is probably a good time to start encouraging people to increase their emergency reserves above and beyond what you would typically do. And so we said, you know what, we were just toying around with ideas and say, what about a financial vulnerability cushion? And, you know, we kind of went back and forth on what that would look like, what that actually means for someone. And, you know, not knowing that the pandemic was going to occur and 45 million people would be out of a job. And, you know, I think that this is one of those things that you don't always necessarily need to have this, but it is always something that I think can be a good thing. You know, you think about emergency reserves. What are those for, Rich? That's for the basics. If you're out of work for a period of time, if something happens and you just can't get in, you don't have disability insurance, you don't have things set up properly in the sense to really get you to a point where your family's secure. And what if something above and beyond happens to you? I mean, I'll tell you, like, for instance, we kind of talked about my knee, right? So for those of you that don't know, I blew my knee out playing basketball, among other things over time. Had to have major surgery. Luckily, I can still work. Thank God for how we were set up and modern technology. But in the event I couldn't, or also not to mention the bills that are coming in, it's astronomical how much some of these things cost. But having that financial vulnerability cushion, I don't have to impact my emergency reserves, and I can go towards that, which has been a really big benefit for me and my family. So there's going to be turbulence in many different ways and things that you're going to face. It's going to be unique to each and every one of you, but having that vulnerability cushion above and beyond those just your ordinary expenses is huge. Because what happens if you lose your job and something like this occurs? Now we're talking about you could be in trouble, and you could really dwindle those funds much quicker,
Yep.
right, Rich?
So keep in mind, we started talking about this financial vulnerability cushion, ironically, about 7 months before the pandemic. Like something that comes out of the blue, you lose your job. The first 6 months of your emergency cash reserve, the first 6 months are the stuff that breaks down in your house, right? The car breaks down, the air conditioner, right? The next 6 months of living expenses is the life gets in the way. So it's really important that you understand to have that. Living smaller is just a buffer, right? The rules that we created help you to live smaller, right? And that also helps in case life gets in the way. If you complete a financial plan, it exposes lifestyle weaknesses, helps you to minimize those. It looks at the things you're doing really well as well. So we're testing outlier situations or events that might have a big impact, but less chance of occurrence. Isn't it funny? We get to see these life-changing events every 10 years, when in finance it says, well, these things don't happen except for every 500 years. Yeah, okay, sure. So there was a question from Judy about permanent life insurance. I personally like permanent life insurance. I ability to have a cash value and grow that money. Some people overfund these life insurance policies. You always have to make sure you have life insurance and the ability to fund these, because it's not as good as term. Term insurance is great when you're younger and you don't have financial resources. As you're more middle-aged, you expand out to a permanent life insurance policy with a dual purpose. One, life insurance. If I don't have a need for life insurance, then I don't need a permanent life policy, but I can overfund those policies and that money will grow. I can select allocations to the S&P 500 and so forth. I can allow this money to grow over time. And then as a part of a retirement income plan, I can take a policy loan out. Since it's a loan, even though you don't have to pay it back, it's not considered income, but for you, it is. So big fans of permanent life insurance. And the fact that Dave Ramsey hates him makes me love him more. So, keep that in mind. So yeah. So here's how we can assist, right? We are fiduciaries. We are here to make sure that we're doing holistic planning. We want to give you the right steps to financial independence, although not popular. Education is such a big part of who we are. We want to make sure you're empowered through the Real Investment Advice blog. I write about Medicare. So I have one about Medicare coming out next week. But we're here to write about all types of things to just educate you and empower you. And if you haven't signed up for Lance's newsletter, which he's feverishly, if you can't do that, you sign up for the newsletter. Lance would have it on Saturday. He works on those on Saturday morning. We have 700 KSEV, Voice of Texas, but podcast, YouTube, we're available. We're available. So we have a survey. Things, if you want to hear from us, rate this presentation. I created this presentation because I think it's just an overall good generic presentation. So I hope that you can to do that. So I want to go through some of these questions here. Yeah. Okay. Yeah. Great. And Judy asked about whole life insurance because she's talking about, I want to reduce my Medicare premiums. Right? These premiums are killers. Yeah, because you're subject to IRMA charges on top of your base premium. Yesterday, we talked on the show that you're most likely, we won't know till November, your Medicare Part B premium is going to be for like $148, probably $168. You're looking about a 13.5% increase in your Medicare premium. If you pull money, Judy, out of a permanent life insurance policy, you pull money out of a Roth IRA, the money, the charges that are adjusted, that attached to adjusted gross income that increase Medicare premium, they don't count as income. So you'll pay the base premium, but you won't have all that, what we call these IRMA or additional charges, depending on how much income. You take money out of your IRA, you certainly could be what Judy said. These premiums are killers. So that's important.
Well, Rich, I think an important part. Hey, I'm back. Yeah, fun audio stuff. So, hey, one of the important parts on that as well, though, is it doesn't just necessarily have to be whole life insurance. It's a permanent life insurance policy. So it could be
Permanent
a number
life.
of different types.
Variable life, permanent life, yeah.
Yeah. And the kicker is that you want to make sure that you find a policy that you can withdraw from, because and you can do so because they're going to charge you interest on what you take a loan against it, is essentially how you're going to take tax-free withdrawals.
Right.
And you want to make sure that you use a little bit of arbitrage, because they credit you the funds that are in the account or even the ones that you borrow, but they're also going to charge you interest. And so we want to find one that you can offset, because it'll let your funds last for a much
continue to grow, right? So
correct.
say my policy loan, I take out 3%, but I'm earning, I'm using numbers, 4%, right? The policy is still going to grow over time, and an insurance company can run an analysis for you. I'm a big fan of permanent life insurance. And again, we want to know what you think. You complete the short post-webinar survey, you'll have a chance to win a Candid Coffee mug.
Hey, speaking of mugs, want to give one more out today.
One more mug.
So Mike Cook, thanks for joining us. Get with Nikki. Nikki will coordinate with you as well, get you a mug out in your mailbox. So, but yeah, thanks for taking over there, Rich. Always fun stuff in the middle of something where audio or, technical difficulties occur, right?
Oh, it's amazing. So I've been on my best behavior because my girlfriend's on this. So look at me. I look good. Hey. No. And what other questions? You have some other questions before we wrap this up? And we'd be happy to have 65 people with us. We're so happy you've been with us.
Nope, that looks good. Hey, thank you guys for joining. If you do have questions that maybe you didn't get a chance to answer, if you feel like we didn't answer, fully, don't hesitate to reach out. You can go to realinvestmentadvice.com, ask a question. Lance gets all of those. Me and Rich will also, any of the planning questions we typically try to address. Go ahead, Rich.
Last thing, please. I know you're going to do the survey, but if you would please, if there's any one of these rules that you sort of use that has helped you, or a rule that you follow that I didn't consider, I would love to hear it, because then I'm going to use it on the radio for Danny and I. We showcase, I think, one of the smartest audiences, and I want to make sure that if there's another good rule that you've been following that works for you, we know about it, or if any of these rules work for you, or they have, like pay yourself first or anything else, we know, and we'd like to talk about it on the radio show on Friday.
Yep, absolutely. So, hey, you can put that in the survey. We'd love to hear from you. If you do have any questions, you need anything, or if you'd like to schedule a meeting or just some time to visit, a quick phone call, see if we can't either help you or point you in the right direction. We'd love to help. So go to realinvestmentadvice.com, ask a question. You can email Rich or myself at Richard or Danny at riaadvisors.com. Thank you guys so much for joining us. We really appreciate you spending your time, like I said, and we'll be doing this again shortly. We're actually going to be getting back to live events here this fall. So hope to see you guys, some of y'all out there. We're going to get back to our retirement right lane class, which is
In the
much more holistic. We'll be in the Woodlands and then we'll be in
September,
Austin. So.
and then Austin in October, but we'll get the dates
Correct.
out to you. But our right lane is revised for all the Medicare, Social Security. Listen, this is a course. This is not a webinar. You sit there for a couple of hours, you learn a lot, especially if you're about 3 to 5 years from retirement on how to prep properly. We are here to help, and we're excited about being able to do it live.
Absolutely. We're going to wrap it up, guys. We're right at the hour. Thanks so much again for joining us. Please take that survey. Give us some feedback. We always want to know what we can and can't, do better. Let us know. Have a great weekend. We'll see you guys soon.